You pay this tax every single day. Most people never see it. It doesn't appear on a paycheck. It isn't listed on a receipt. No bill arrives in the mail. No government official asks for your permission. And yet, year after year, it takes a larger share of your wealth than almost any tax you'll ever pay. Imagine placing $100 in a drawer. You leave it there. You don't spend it. You don't lose it. You don't invest it. 10 years later, the money is still there. The problem is, its value isn't. Someone took part of your purchasing power, and they did it without touching a single dollar. Most people blame corporations. Some blame politicians. Others blame the economy. They're all looking in the wrong place. Because the greatest thief in modern history doesn't wear a mask. It doesn't break into your house. It doesn't steal from your bank account. And yet, it quietly makes millions of people poor every single year. My name is Milton Friedman. And today I'm going to show you exactly how it works. The first thing you must understand is simple. Money is not wealth. Most people believe it is, but it isn't. Money is only a claim on wealth, a tool, a measuring stick, nothing more. Real wealth is what money can buy: food, housing, energy, transportation, security, freedom, time. The problem begins when people confuse money with purchasing power, because the number can stay exactly the same while the purchasing power disappears. Suppose I hand you $100. A year later, you still have $100. Most people would say, I didn't lose anything. But what if that same $100 now buys only $90 worth of goods? You lost wealth, even though the number never changed. That is the illusion. And once you understand that illusion, you begin seeing the hidden tax everywhere. Most people spend their entire lives chasing money, working for it, negotiating for it, saving it, worrying about it, yet very few stop and ask a simple question. What exactly is money? Imagine a man stranded alone on an island. No stores, no banks, no businesses, no stock market, no employers. Now imagine I drop $1 million onto that island. Has he become wealthy? Of course not. He still has no food, no shelter, no clean water. The money changed nothing, because money itself is not wealth. It is only a claim on wealth. Ticket. A bridge between your effort today and the goods you wish to consume tomorrow. And inflation attacks that bridge, not the paper. The paper remains. The bridge shrinks. Every year, quietly, relentlessly. That is why inflation is so deceptive. People see the dollar. They don't see the shrinking bridge beneath them. Now let me ask you a question. What happens when more money is created, but the amount of goods remains the same? Most people never ask this. Yet it is one of the most important questions in economics. Imagine an island with 1,000 apples and $1,000. Each apple costs $1. Simple. Now imagine the money supply doubles. $2,000. Still only 1,000 apples. Did the island become twice as wealthy? Of course not. There are still only 1,000 apples. The only thing that changed is the amount of money chasing them. Prices rise, not because apples became more valuable, because money became less valuable. This is the principle most people miss. Inflation is not rising prices. Rising prices are the symptom. The cause is the decline in the purchasing power of money. Think about how most people describe inflation. They say gas prices went up. Groceries got expensive. Rent is too high. Notice something? Every statement focuses on the product. Very few focus on the money. And that difference matters. Imagine using a ruler made of rubber. One day the ruler stretches. The next day it stretches again. Suddenly everything appears longer. Did the objects change? No. The measuring device changed. Money works exactly the same way. When the measuring stick becomes unreliable, everything appears more expensive. The public blames the products. The economist examines the measuring stick. And more often than not, that is where the answer is found. This is why inflation creates confusion. People see the symptoms. Few investigate the cause. And when you misunderstand the cause, you become vulnerable to the consequences. The cruelest part of inflation is not that it affects everyone. The cruelest part is that it affects everyone differently. The wealthy often own assets, businesses, real estate, investments. productive enterprises. These things tend to adjust over time, but the person who depends entirely on wages and savings, they face a different reality. Their dollars become weaker, while their expenses become stronger. Food rises, rent rises, utilities rise, insurance rises. Everything rises, except purchasing power. This is why inflation acts like a hidden tax. A normal tax is visible. You see it, you calculate it. You complain about it. Inflation is different. It operates quietly. Most people notice the higher prices. Few connect them to the underlying cause. And because they don't see it, they don't defend themselves against it. Let me give you an example. Imagine two neighbors. Both earn the same income. Both work equally hard. Both save diligently. The first keeps everything in cash. The second gradually converts part of his savings into productive assets. Years pass, inflation arrives, prices rise. The first neighbor watches his purchasing power decline. The second watches his assets adapt. Neither worked harder. Neither became more intelligent overnight. The difference was understanding. One stored wealth in currency alone. The other stored wealth in things that could respond to changing conditions. This is why financial education matters, because the greatest differences in wealth often come not from what people earn, but from what they understand. For decades, I watched ordinary people make the same mistake. They believed saving money was enough. They worked hard, spent carefully, saved consistently, and then left their savings exposed, not to criminals, not to fraud, not to thieves, to inflation. Imagine carrying water in a bucket with a tiny hole. At first, the leak seems insignificant, almost invisible. Nothing dramatic happens. Then another year passes, and another, and another. The water keeps leaving. Eventually, the bucket is half empty. Inflation works the same way, not dramatically, gradually, relentlessly. The danger is not 1 year. The danger is 30. Compounding works both ways. Everyone talks about the miracle of compound interest. Invest a little. Wait long enough. And small amounts become large amounts. But few discuss the dark twin of compounding. The compounding of loss. A small decline in purchasing power appears harmless, almost invisible. 1 year, then another, and eventually decades pass. The damage accumulates quietly, like rust on steel, like erosion on stone, like water through that bucket. Time magnifies whatever system you are living inside, whether it is helping you or hurting you. Once you understand inflation correctly, you stop asking, how much money do I have? And you begin asking, how much purchasing power am I preserving? That is a completely different question, because wealth is not measured in dollars. Wealth is measured in what those dollars can do, what they can buy, what they can produce, what they can protect. The people who build lasting wealth understand this instinctively. They focus on preservation as much as accumulation, because every dollar earned represents hours of life. And protecting purchasing power means protecting those hours. That is why inflation is not merely an economic issue. It is a life issue. The hidden tax survives for one reason. Most people measure their financial lives in nominal terms, not real terms. They ask, am I earning more than last year? But rarely ask, can I buy more than last year? Those are not the same question. A worker may receive a raise, feel successful, celebrate, and still become poorer. Because if prices rose faster than income, the raise was an illusion. The number increased. The purchasing power did not. This is why inflation is so powerful. It disguises itself. It allows people to feel richer while becoming poorer. It changes the numbers first. The reality comes later. And by the time reality arrives, most people have forgotten where the process began. I want to leave you with one idea. The purpose of economics is not predicting markets. The purpose of economics is understanding consequences. Every policy has consequences. Every decision has consequences. Every expansion of money has consequences. The question is never whether consequences exist. The question is, who pays for them? And throughout history, the hidden tax has almost always been paid by the people who least understood it, which is why knowledge matters. Because the moment you understand how purchasing power disappears, you stop measuring wealth the way most people do. And once that happens, you begin seeing the world differently. Tonight I want you to do something simple Take a dollar bill out of your wallet. Look at it carefully. Then ask yourself one question. Will this dollar buy more for me 10 years from now? Or less? That single question explains more about wealth than most financial advice ever will. Because the goal is not merely to earn money. The goal is to preserve what money can buy.